All right. Happy Friday, all you magnificent melonheads. Good morning, everybody. Today is July 28th, 2023. It's Friday. I hope you guys are well. Got to send a shout out to all you wonderful melonheads out there, and particularly all you fine people who are here in the live chat day in and day out in the morning. Don't think I don't notice you guys. Just wanted to say I have this. I got my iPad going with my live stream playing in real time. Oh, there's me, the infinite loop going on. Every day I see what's going on in the live chat. I notice you guys. Shout out to you guys. Thank you for everybody who is weighing in, letting me know what you guys are seeing in the economy, and also to my blue wrenches, my wonderful mods who keep things neat and tidy in the chat. Thank you guys for everything you do for the channel. Top story this morning. Well, there's a two-way tie for the top story this morning. The BOJ is the big one. Everybody's talking about the Bank of Japan. They followed through on that leaked article from Nikkei. I did a video on that last night. If you guys want to go back and check that one out, I'm not going to rehash the whole story. But long story short, the Bank of Japan is starting to back away from their ultra-dovish policy of yield curve control. They're going to slowly let interest rates start to rise. That's important because that could lead to higher interest rates here in the United States as investors dump U.S. government debt in favor of Japanese government debt. That would put upward pressure on interest rates, upward pressure on the dollar, and we have a debt-based economy. That could be very bad for the U.S. economy. So that started last night. It wasn't a huge surprise, not after that Nikkei article was leaked around 1 o'clock yesterday afternoon. That's Eastern time, by the way. But it was a departure from a policy that's been in place for years, so that's moving markets this morning. Now, the other big news was Intel earnings last night. Intel posted a blowout earnings report. Everybody was talking about that after hours. Intel stock is up big this morning. Now, Intel returned to profitability. They've had 2 consecutive quarters of very big losses. They've had 6 consecutive quarters of revenue losses. Well, Intel had a whole bunch of layoffs earlier this year. Remember all the tech layoffs from the first quarter? We talked about those stories. And so those cost cuts have resulted in better earnings for Intel. Now, I say better earnings because Intel's revenue continues to decline. Revenues over at Intel were down 15% year over year for this quarter. So I got to throw my permable disclaimer out there. There it is on the sleeve. I always find the gray cloud to every silver lining. But Intel's big beat was driven by layoffs, was driven by cost cuts. It was not being driven by an improvement in the sector. And so as we look across the Nasdaq this morning, we're seeing all the chip names are higher. Broadcom, Skyworks, NXPI, all the chip makers are higher this morning. I don't agree with that sentiment. Does the fact that Intel laid off people and improved their bottom line, does that improve the business prospects over at Broadcom? No, it doesn't. And yet Broadcom stock and all the other chip stocks are up on Intel earnings. Remember, Intel's sales are still down. People are still buying less chips. So I don't get this crazy amount of enthusiasm. Again, this market is just so desperate for any reason to go up. They will find that one data point as an excuse to take the market higher and then ignore all the other data that says to the contrary. And I see that going on with Intel this morning. Other news going on in earnings, we got Ford reported yesterday. Ford reported pretty good numbers. Their earnings were good, but there was a little bit of a problem with their EV story. It seems EV adoption is not as rapid as Ford and as this market would like. You know, oh my goodness, this market just loves EVs. The only thing they like more than EVs is artificial intelligence. Well, Ford's EV business is lagging. It was actually Ford's legacy business, their big commercial trucks and Ford Blue, which is basically their F-150s, their typical vehicles. That's what was propelling their earnings higher, not their EVs. They're actually losing money on their EVs, and the adoption is slower than they wanted. So Ford stock is down a little bit right now. And guys, we're spending all this money, all this government borrowed money, largely responsible for the blowout quarter GDP report we got yesterday, all this economic growth. A lot of that is being driven by all the Inflation Reduction Act, the borrowed money that we're using to build factories that are going to build chips and batteries for EVs. Well, the market doesn't want EVs, at least not as much as they're telling us, and Ford's earnings are a case study in that. So all of this money, all of this borrowing bender that we're on, and all of this monstrous spending on all these new factories, it's malinvestment. It's not going to yield the return that we're hoping it was. And that's why I'm so bearish on this big debt pile that we still accumulate, because it's not going to result in economic prosperity, but we are going to be left with the bill for it. That's going to be a big problem for other businesses that are healthy. Elsewhere going on in earnings, we've got ExxonMobil and Chevron. Both posted big declines in earnings, down 56 and 48% respectively. No big surprise there to see the oil majors down, because oil prices versus the same quarter last year, you remember this time last year, oil prices were going vertical because of the invasion of Ukraine and the reaction in energy prices. And then, of course, President Biden's dumping of the Strategic Petroleum Reserve sent oil prices crashing after that, and they remained sharply lower than they were this time last year. So we got a big decline in Chevron and ExxonMobil earnings based on just lower energy prices. Nothing too surprising there. And with that, let's shrink my big melon of a head and see what is going on in markets. The CNN Fear Greed Index still in extreme greed territory at 77, although well down from that 83 that we had yesterday. After that little bit of a sell-off, and I emphasize a little bit of a sell-off, it was a 300-point intraday swing yesterday in the Nasdaq. We opened up 200 points and closed down about 70, but we're getting most of that back today and then some after this run from Intel earnings. The S&P right now is up 28 points or 0.63%, trading at 4,565. The Dow is up 118 points this morning or 0.34%, 35,401 for the Dow. And the Nasdaq is the big winner this morning, up 158 points, 1.13% at 14,209, clawing back everything it gave up after the open yesterday. Much higher for the Nasdaq. Looking in commodities, we've got gold is up about $7 this morning or 0.39%, 1,953 for gold. Silver's flat, unchanged on the day, 24.36 for my favorite of the shiny. Platinum and palladium are both down 0.83%, not a big move in the PGM metals. Crude oil is down 89 cents this morning or 1.11%, trading at 79.19. It's been a heck of a week for crude oil. And we've been watching wheat futures, guys. Wheat futures down again this morning, $18 or 2.5% on a lack of escalation in the Ukraine-Russia conflict in the Black Sea. I say lack of escalation. It's not that they're not still targeting grain silos. They're still targeting infrastructure. The Russians are still attacking those port cities. It's just it hasn't spread to ships yet. They're not sinking commercial ships, which was the big fear, that the grain carriers coming in and out of the Black Sea were going to start getting sunk. That hasn't happened yet. So some of that initial panic from the escalation in the Black Sea has now worn off a little bit, and wheat futures are coming back down to earth a little bit. Looking at the U.S. dollar, the DXY is at 101.66. That's down 11 basis points this morning. That's after a ripping move yesterday in the DXY, moved sharply higher based on the slight divergence between the European Central Bank and the Federal Reserve, something I talked about in my video last night, but also on that news of the Japanese easing up on their yield curve control policy. So right now, the Dixie giving back some of those gains from yesterday, still well above its levels from a day ago, though. And in the bond market right now, again, giving back some of the gains from yesterday. The long end of the yield curve is a little bit lower. We've got the 30-year yield is down about 1 basis point, 4.04% on the 30-year. The 10-year is down 3 basis points at 3.98. It was much lower than that earlier today. So again, I would expect this little bit of a move lower after the run that the 10-year yield made yesterday. Nothing too surprising here. The 2-year, 4.89, down about a half. Oh, that's down 5 basis points, excuse me. And the 1 month is at 5.38. That's up about 2 basis points. And here is the story that is moving markets this morning. The Bank of Japan just shocked markets with a policy tweak, and here's why it matters. We didn't expect this kind of tweak this time, said I'm going to try to pronounce this one, Shigeto Nagai, head of Japan economics at Oxford Economics. He told CNBC, the Bank of Japan has been dovish for years, but its latest move has left markets wondering whether a change is on the horizon. Here's a hint, it is. Speaking at a press conference following the announcement, BOJ Governor Kazuo Ueda played down the change in the policy stance, but that didn't stop markets from reacting. And here's a bit of a summary of what the change is. In a policy statement, the BOJ said it will continue to allow 10-year Japanese government bond yields to fluctuate within the range of 0.5 percentage points either side of its 0% target, but it will offer to purchase 10-year Japanese government bonds at 1% through fixed rate operations. This effectively expands its tolerance by a further 50 basis points. That's a lot of central bank speak. What are we saying here? The Japanese central bank had pegged the interest rates on their 10-year government bond yields, the JGB or Japanese government bond. They had pegged it at 0.5%. If it went above that, they would immediately print money to buy the bond and send the interest rates back lower. And they would print an infinite amount of money to accomplish that. So what they're saying is we're going to start letting those yields go higher than 0.5%. We're still going to put downward pressure on those yields as they rise, but we're not going to put an absolute cap on it until it gets to 1%. So they're raising the ceiling and they're applying this sliding scale of how much downward pressure they're put on the yields up until a maximum of 1%. So this is a hawkish move from an ultra-dovish position. They are backing away slowly from their yield curve control policy. And you could see that yesterday at 1 o'clock when that story leaked about what the BOJ was thinking about doing. We had the 10-year JGB, the Japanese government bond, went from 0.43% right up to 0.49 or 0.5. And then overnight, when the Japanese officially made the change, we saw another step change in the Japanese 10-year yield, now yielding about 0.55. So already Japanese government bonds are reacting to this move from the BOJ. You can also see it in the Japanese yen giving back some of its gains from yesterday. Here was that big move at 1 o'clock in the afternoon Eastern time yesterday. The yen came down. Then there was another big move down last night when they actually implemented the change, although it's giving back some of that at the moment. The Japanese yen is currently at 140 to the dollar. And looking at the U.S. 10-year yield right now, it is down a little bit today. Let's zoom in on that. Here's that little bit of a red candle with a little bit of a pullback today after that big green candle up yesterday, but still well above this trend line. So watch that 4.0% level. And also, guys, watch this level for an important sign of a breakout somewhere around 4.06, 4.07. That's these previous highs that it bounced off 2 times. If we see it move above that, that would be an indicator to me, a completion of what looks like a little bit of a cup and handle pattern. I know this chart is starting to get sloppy. I got a lot of drawings on it, but that would be a bullish indicator, meaning the yields are heading higher. Also going on this morning, we got the PCE, the personal consumption expenditures came out. This is the Federal Reserve's favorite measure of inflation. When you hear Jerome Powell talk about his 2% inflation target, he's not talking about CPI, he's talking about PCE. This inflation indicator doesn't get as much press as the consumer price index, but this is the one the Fed watches, and it just came out today at 3% year over year. That is down from 3.8% last month. So that's a big drop in PCE, further indicating that inflation is coming down closer to the Fed's 2% target. Now, remember, Powell said he was going to stop raising interest rates before we get to 2%. Well, we just went from 3.8 to 3. That would indicate we're only a few months away from that 2% target if this trend continues. So it could mean we're almost done with the rate hike cycle, even though Powell told us 2 days ago that he's still open to a rate hike in September or possibly November. Well, the market is calling his bluff. Right now, this is the CME's Fed Watch tool. This is the likelihood of an interest rate hike in September. And right now, the market is saying, Jerome Powell, you're bluffing. Only 20% likelihood of an interest rate hike at the September FOMC meeting. 80% of people are saying there's going to be no hike. But then if you move over to November, you get something similar. Only a 31% chance of a hike even in November. 65.5% of people saying no hike even in November. And even at the end of the year in December, we've still got only about a 28% likelihood of another hike to interest rates. So the market is saying, Jerome Powell, you're bluffing. We think you're done with your rate hikes. And that PCE indicator today kind of supports that. If we see inflation at 3%, down from 3.8 in a month, and Powell said he's going to stop hiking before we get to 2% because of the lag in interest rates actually affecting the economy, that would mean we're probably pretty close to done. Elsewhere in the market right now, we got Intel jumps 7% as it returns to profitability after 2 quarters of losses. This is what's driving stocks this morning, in particular the Nasdaq. They're loving these Intel earnings. Intel reported second quarter earnings on Thursday and showed a return to profitability after 2 straight quarters of losses. The company issued a stronger than expected forecast and the stock jumped and extended trading. Intel reported second quarter earnings on Thursday, showing a return to profitability after 2 straight quarters of losses and issuing a stronger than expected forecast. Now, this is kind of the important stuff here, guys. Revenue fell 15% to $12.9 billion from $15.3 billion a year ago. Does that strike you as a healthy business with revenue down 15%? Now, maybe that revenue was down less than the market was expecting, and that's possibly explaining why the stock is jumping. But sales are down. They laid off a lot of people. That's why this company is looking better. This is the 6th consecutive quarter of declining sales. Intel CEO Pat Gelsinger said on the call with analysts that the company still sees persistent weakness in all segments of its business through year end, and that server chip sales won't recover until the fourth quarter. Again, this doesn't sound like a very healthy business to me. Persistent weakness in all segments? But the stock is ripping higher. He also said that cloud companies were focusing more on securing graphics processors for artificial intelligence instead of Intel's central processors. David Zinsser, Intel's financial chief, said in a statement that part of the reason the report was stronger than expected was because of the progress the company has made towards slashing $3 billion in costs this year. Earlier this year, Intel slashed its dividend and announced plans to save $10 billion per year by 2025, including through layoffs. So the company's business is not any healthier. The company is not making any more money. The company is selling less chips. The reason why this report was so good is because they laid people off. Again, this is not a particularly healthy business. Now, they're making the right decision in cutting costs in this environment, but again, they're still being forced to cut costs. And this gives you a good idea, guys. These charts are showing you Intel's revenue numbers. And really, pretty much since the fourth quarter of 2021, Intel's revenue has been in decline. 6 consecutive quarters of decline. Now, we just came in at $12.9 billion for Intel's quarterly revenue. So sequentially, that is up from the first quarter this year, where they had 11.7, but still down massively versus the same quarter a year ago. You can also see this here in the red, where they're showing the year-over-year quarterly change in revenue growth. 1, 2, 3, 4, 5, and now 6 is not showing up on this chart, this latest quarter. 6 consecutive declines in year-over-year revenue growth for Intel. But you'd never know looking at the stock. Intel stock right now is only up 3.6%. It was up over 7% after hours last night. So it looks like the euphoria is wearing off a little bit on Intel here. But we'll keep an eye on that one. Also going on, we got ExxonMobil and Chevron. Exxon posts 50% profit slump, joins peers in the energy price hit. ExxonMobil said on Friday that they reported a 56% slump in second quarter profit, missing Wall Street estimates and joining rivals hurt by a sharp drop in energy prices and lower fuel margins. Second quarter results from oil majors have tumbled from huge profits booked a year ago after Russia's invasion of Ukraine sent oil and gas prices soaring. Chevron, Shell, and Total Energies have reported profit falls of 48%, 56%, and 49% respectively. So tough quarter for the oil space. No surprises, though. That's what we were expecting. Last one I want to talk about today. Ford stock is falling after strong results. EVs are an issue. You know, the EVs that we're spending all this borrowed government money on to build all these factories to force EV adoption on people who, looks like from this article, don't want EVs, probably because their range sucks and they're very expensive and they take so long to charge. Those are problems that need to be solved. They're problems for the engineers. They're not insurmountable, but for now, EVs are not practical for most buyers, and the earnings are reflecting this. Ford investors have plenty to worry about these days. Interest rates, car pricing, and vehicle demand. At least earnings aren't a problem. Ford posted better than expected quarterly results and raised its financial forecast for the full year, sending the stock in late trading, but that did not last. The stock is now heading lower. Electric vehicles are one reason for the dip. Ford's Model E, the company's electric vehicle division, reported a $1.8 billion in sales and a loss of $1.1 billion. EVs are losing money at Ford. Comparisons to the year-ago quarter aren't meaningful for the fledgling division. The Model E loss was expected because making cars requires economies of scale. Automakers need to ship a minimum of 100,000 vehicles a quarter to approach profitability. That's not saying achieve profitability. That is saying to approach profitability. Ford delivered 34,000 fully electric and hybrid vehicles in the second quarter. That's up from 12,000 in the first quarter. Now, they're saying delivered. They're not saying that they sold them, There's stories all over the web about EVs starting to pile up at dealerships because the market doesn't want them. So forget the deliveries numbers for the electric vehicles. How many are selling? Noticeably absent from this article is sales of EVs. That's because they're not good. It will take a little longer to reach the scale required for profitability. CEO Jim Farley said on the company's conference call that Ford is targeting a 600,000 EV production run rate by the end of 2024, but the prior goal was that 600,000 by the end of 2023. The market is not demanding these vehicles, and so they're slowing down their rollout. The standout division, however, was Ford Pro. That's Ford's commercial business, their big rigs. Sales came in at $15.6 billion. That's up 22% from a year earlier. Operating profit came in at $2.4 billion, up $1.5 billion. So that's a bit of a surprise to see Ford's commercial division doing so well, especially considering all of the struggles in the logistics sector, yellow trucking, UPS, FedEx. It's a tough time to be moving things. Well, Ford's commercial, their big trucks, are actually doing pretty well. Put a pin in that one. That's an interesting data point. Also, Ford Blue, the company's traditional car business, or internal combustion engines, they generated $25 billion in sales. That's up 5% from a year before. Operating profit came in at $2.3 billion, down $200 million. So it's the big gas-burning polluters that are doing well for Ford, not the unicorns and rainbows EVs that the government is trying to jam down everybody's throats. Note that free market capitalists out there, the market does not want EVs. Ford stock right now down 2.75%, trading at $13.35. All right, guys, I got a couple of people I got to say thank you to. I saw you out of the corner of my eye. What's going on, Dan Hedin? Thanks, brother. I appreciate the super chat and the support of the channel. He says, I'm rocking 3 generators to watch this stream in HD. Keep it up, Jack. Please hit that like button to help get the info out to more people. Thank you so much, Dan. I appreciate that, sir, the kind words. And guys, PJM, the biggest grid operator in the country, is putting out warnings about the heat and about peak load on the power grid. So everybody... get ready for power outages. I'm not saying they're definitely going to happen, but right now there is a lot of strain on the grid. Another example of why EVs at this moment are a terrible idea, because we can just barely keep the lights on right now, let alone put everybody's car demand on the grid. So EVs are not looking so good at a time when the grid can barely stay online. Dan, I'm sorry you're on the generator, brother. Hope the lights come back on soon for you out there. And thanks again, sir, for the super chat, the support of the channel. And thank you, Kevin DeBella, sir. He says, I want a yellow oil, but I'm worried summer demand will end soon. Odds that Biden starts replenishing the SPR. I would not plan on the SPR replenishment propelling prices higher. Biden will hand that problem off to his successor, especially if his successor comes from the other side. He will be happy to hand that problem off so he can blame higher oil prices on the next guy. So I don't think that refilling of the SPR is going to propel prices higher. I do think the Saudis and the Russians could propel prices higher, as well as that declining Baker Hughes rig count in the United States. A lot of oil rigs in the U.S. have been shutting down for the last 3-4 months or so. Now, U.S. oil production is still on the rise because the rigs that are running are very productive. It's only the unproductive rigs that are shutting down. But without new rigs coming online, as those older rigs mature and their production starts to decline, there will be no new production coming online to replace that. So I think we're a few months removed from a decline in U.S. oil production. And if that coincides with the Saudis and the Russians maintaining their production cuts, we could see tighter supply in the oil markets. The flip side to that coin, something you need to watch out for, look at yellow trucking. Look at how things are not moving. Look at the cost of oceanic freight. The global economy is slowing, so oil demand is slowing even as oil supplies tighten up. And it remains to be seen which one of those forces is going to prevail over the other. At the moment, it looks like the supply forces are prevailing over demand as oil prices head higher. So it's a dangerous trade, but right now the oil chart is looking very good, Kevin. Thank you, sir, for the super chat and the support of the channel. And thanks, Dan, who's back again. Thank you, Dan. He says, remember to get funding from the government. Remember to get funding from government. The automakers need to make sales numbers. Government will need to revise the numbers. You know, that's another thing with all the subsidies and the tax benefits and everything that they're throwing at the EV makers. The market still doesn't want it. This is not good investment. Teslas are cool cars. The EVs are novelty items. They're very comfortable. They're very luxurious. But for the average person who's got a long commute or may occasionally need to drive more than 100 miles in one direction or the other, an EV is not practical. And no matter how much money the government throws at EVs, you can't change that, not without a giant leap forward in battery technology that improves the charging time and the range of electric vehicles. Not to mention, we need to fix the grid. Shout out once again to Dan Hedin. I hope the lights come back on for you, brother, so you don't have to rock the generators to follow my streams. All right, guys, that's all I got for you today. I want to say thank you, everybody, for the super chats and also for your time, for spending it with us. Shout out to everybody in the live chat and also to my Patreon supporters. You guys are awesome. Link down below should you feel so inclined. And, guys, don't forget that like button when you're here. It really helps. The algo hates me. They do not want this message going out. So every thumbs up and every share you guys can give me is a big help to the channel. Also, hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.